Hello friends. So in this video we are going to discuss all the study material questions, ICAI study material questions. So today we'll start with security valuation chapter. Every chapter like this we are going to discuss one by one, and I'll also mark you the important questions which are to be noted. So yeah, okay. Shall we start? Okay. See, take question number 1 for discussion. A company has a book value per share of 137.8. Its return on equity is 15% and it follows a policy of retaining 60% of its earnings. If the opportunity cost of capital is 18%, compute the price of the share today using both dividend growth model as well as Walters model. So basically they are asking dividend growth model means, okay, of course the Gordon's dividend growth model and then Walters model. See, first step they have computed earnings per share. Earnings per share, very simple. Book value per share into, okay, you have return on equity. You will get earnings per share. How you get book value per share multiplied by return on equity, earnings per share? Book value per share is nothing but equity share capital plus reserves and surplus, or I simply call it as equity divided by number of shares into return on equity is nothing but, okay, the PAT return divided by equity, which is nothing but equity share capital plus reserves and surplus. Okay, these two gets cancelled and you will get ultimately, okay, PAT divided by number of shares, which is nothing but EPS, which is nothing but EPS. Appa EPS ke, okay, simply is nothing but book value per share multiplied by, okay, return on equity. How much is that? 137.8 into 15% will give you 20.67. Now you have EPS. You have retained 40% or paid out 40. See here, what you have done is that you have retained 60% of the earnings, which means 60% is the retained portion, 40% is payout ratio. So 40% into 20.67, you will get 8.27 as dividend. And of course growth you need to find out now. Okay, KE minus G, you need to find out growth. What is growth? G is equal to nothing but B into R, where B is nothing but retention ratio into rate earned on the retained portion, which is here they have given return on equity. We assume return on equity also to be return earned on retained portion, which means 60% into 0.6 into, okay, 15%, 0.15, you will get 9% as the growth. So you have dividend, you have KE minus G, apply the formula and you will get 91.89 as the value per share as per dividend growth model. Next, Walters model. Walters model, very simple. Okay, apply the formula. What is that? D plus R by K into E minus D. Okay, the E minus D is nothing but retained portion. E minus D is nothing but the retained portion and the whole divided by K. How much is that? Okay, dividend is 8.27 and then 15 by 18% into 20.61 minus 8.27, the whole divided by 18, you will get 103.35. Simple application of the formula, then find out the solution. Next, question number 2. Question number 2 is about right shares. Okay, see, ABC Limited shares are currently selling at 13 per share. There are 10 lakh shares outstanding. The firm is planning to raise 20 lakhs to finance a new project. What are the ex-rights price of shares and the value of right if firm offers one right for every 2 shares held, firm offers one right share for every 4 shares held, and last part, how does the shareholders' wealth, okay, holding 100 shares change from 1 to 2, which means first what happens to wealth in case of part A, then part B, how does rights issue increases the shareholders' wealth. Okay, we will see whether it increases or it remains same in case of rights issue. This is a question that is being asked. See, first in a solution, first option, what is the X rights price you need to find out and value of right. Okay, see, X rights price, before that, what you need to find out now? Current subscription price you need to find out. The firm offers one right shares for every 2 shares held. Assume now there are 10 lakh shares outstanding, which means if in case the firm offers one right shares for every 2 shares, currently there are 10 lakh shares, up a new right shares is 5 lakh shares. Are you understanding? Which means 20 lakhs is the amount to be financed by for this project divided by 5 lakh shares as per this case 1. Okay, case 1, how many shares, what is the price of the share? The rights price will be 20 lakhs divided by 5 lakh, which means at what price the new funding is being done, 20 lakhs divided by 5 lakhs, which is 4. correct? See, number of shares to be issued 5 lakhs, subscription price is 20 lakh divided by 5 lakhs, which is 4 lakh. Upper rights subscription price is 4 lakh. Now X rights price is very simple. See what you have to do. See, existing number of shares, which means 10 lakh shares into current share price 13. Current share price is how much? 13 per share. Okay, we already know that 10 lakh into 13, this is existing number of shares into current share price plus new rights issue. Rights shares have been issued now. How many shares? 5 lakh shares into right price. At what price? Okay, subscription price it was issued 4 per share, correct? The whole divided by what is the denominator? New shares plus existing shares, which means denominator existing shares plus new shares, right shares issued, up a total number of shares outstanding, which means 130 lakhs plus 20 lakh divided by 15 lakhs, 10 rupees. This is the X rights price. What do you mean by X rights price? Okay, the fair theoretical X rights price, the fair value of the share post rights issue, which means after the rights issue, this should have been the share price. Okay, the quoted market price might be something different, but this should have been the price. This is theoretical X rights price. What is value of right? Very simple. Value of right is nothing but theoretical X rights price. Value of right is nothing but, okay, theoretical X rights price, X price minus, okay, what is the theoretical X rights price minus subscription price, okay, 6 rupees is the value of right. The value which you are enjoying, the extra benefit you are enjoying through this rights issue. Okay, see here. So value of right per share. This is overall value of right, which means in the case 1 they have issued, okay, 1 share for every 2 shares held, correct? Case 1, okay, 1 right share for every 2 shares held. Hence the value of right comes to 6 rupees. Now value per right, if you want to find out value of right per share basis, how will you find out? Very simple. See, this is the total value you have got 6, but okay, for every right share is being issued for 2 shares, upon divided by 2, you will get 3 rupees per on a per share basis. What is the value of right? Okay, that is 3 rupees. Next, case 2, same thing you work out for second scenario, whereby, okay, one new right share is being issued for every 4 shares held, correct? Case 2 what they asked us to compute X rights price, value of right. Okay, value of right on a total basis also you can compute, or on a per share basis also you can compute, that is irrelevant. And they are asking you recompute the same in the second option. Very simple. Okay, see, 20 lakhs divided by 2,50,000, because 10 lakhs existing shares, 1 share for every 4 shares. Now what with the right shares? Right shares new shares will be issued, 2.5 lakh shares only will be issued, correct? How much is to be financed? 20 lakhs. So 20 lakhs divided by 2 lakh, 8 rupees will be the subscription price. So I raise new shares at 8 rupees. Okay, if you are offering 1 shares for every 4 shares. Up X rights price is nothing but 1,30,000 plus 20,000, same computation. Denominator new number of shares will be 10 lakh old shares, which means existing shares, plus new shares of 2,50,000. You will get new X rights price of 12 rupees. Value of right, X rights price minus subscription price, you will get 4 as value. Okay, value of right, but this is on a total basis. If you want to compute per share basis, very simple. Okay, for 4 existing shares only 1 right is being issued. Up 4 shares denominator you divide it by 4 shares. 12 minus 8, 2 by what is that? Yes, 12 minus 8, 4 by 4. You will get 1 as the value of right per share. This is on a total basis and this is per share basis. Next, last computation, calculation of effect of rights issue on wealth of shareholders. Wealth, who is holding 100 shares? See, a shareholders is holding 100 shares. Conclusion you already know, I discussed. See, very simple. In the rights issue, if the company is coming up with the rights issue, if you are subscribing to the rights issue, you will not lose wealth. Okay, or if you are, what do you say? If you are renouncing your right in favor of some other person, then also you will not lose any value. But if you sit idle, if you don't do anything, then you will lose the value. That is the crux of the rights issue discussion, correct? We will see how it impacts. See, very simple. When firm offers 1 shares for every 2 shares held, value of shares after rights issue will be 10 rupees, theoretical X rights price, correct? I already told you, after the rights issue, the company's share price will drop to 10 from 13. Existing the share price was 13 rupees, from 13 it will drop to 10. If this is the case, value of shares after rights issue, 150 shares into 10, 1,500 will be the value, correct? And now amount to be paid to acquire the right shares, 50 into 4, which is 200, and Okay, for one share, for every 2 shares, if 1 share is being issued, na 1300 will be the net value. Are you understanding? Okay. Next, when firm offers 1 share for every 4 shares held, in that case what happens? Value of shares after rights issue, theoretical exercise price in second case is 12 rupees. Okay, 12 into 125. 12 into 125. Why this is 150 and 125? Can you tell? Very simple. See, existing share, see 100 shares. 100 existing shares, new shares, in case the rights issue ratio is 1:2, okay, in that case, what will be the total number of shares? Denominator 100 shares plus 50 shares, 150 shares. Here in second case, okay, if you are holding 100 shares, then new rights issue, rights shares will be 25 shares. But total comes to 125 shares. 125 into 12, 1500 minus the cost to acquire those shares. The value of right, very simple. Okay, here you have 25 new shares. For that is coming free. No, the value of right you need to pay. That is total 8 about minus 200. See here value of right is 4. Value of right, okay, is 12 minus 8 rupees. 8 rupees is what? 8 rupees is what? Yeah. See here, 8 rupees. Value of right, 12 minus 8 compute pannolla. Here, 12 is what? X rights price. Correct? Minus 8. What is this 8? Tell me. Subscription price. Same way, here, for subscribing the right, okay, additional 25 shares free, or you have to pay something, you have to pay. How much you have to pay? 8 rupees you have to pay. About 25 into 8, 200 is the total cost to be paid to acquire the new shares. About total value 1500, 120 shares, total value is 1500, but additional shares were acquired by paying 8 rupees, so 200 you reduce, you will get 1300. In both the cases, okay, the value remains same, and the wealth of the rights issue before the wealth of the shareholders before the rights issue, who is having 100 shares, one person is having 100 shares into current market price, which is 13. So multiply it, you will get 1300, which means all these scenarios shows that, okay, if you are subscribing to the rights issue, you will never lose the value of the share. So there is another question, okay, whereby examination question, one question I have marked in the as per our module, I have told that, okay, where you are renouncing your right, then also the shareholders' wealth will not change. Partial renouncing or complete renouncing, the shareholders' wealth will remain same. Only in case when you don't do anything, you don't subscribe to the right as well as you don't sell your rights. In that case, your wealth will be reduced. So yeah, that is not covered in this question. This question is specific about, okay, in case you are subscribing. In case you are subscribing to the rights issue, what will be the impact on the wealth of the shareholders, that we discussed. Okay, next question number 3. Next question number 3. MNP Limited has declared and paid annual dividend of 4 per share. It is expected to grow at 20% for the next 2 years and 10% thereafter. The required rate of return of equity investors is 15%. Compute the current prices at which the equity share should sell. Present value factor for all this given. Okay, see, very simple question. And growth rate is given. Yes, expected to grow at 20% for the next 2 years and 10% thereafter. See, I told you, wherever growth rate is not stable initially, you cannot use the perpetual growth, constant dividend. This D1 by KE minus G, this is nothing but constant perpetual growing dividend. This is a formula for constantly growing dividend, and the growth is also perpetual. Now, this formula you can use only after the growth rate stabilizes. Okay, not from here. In this question, what they have asked now, first 2 years ago 20% step growth, 20% growth is happening. Thereafter, it is growing at 10% forever. Correct? Up this formula you can apply only at the end of second year. Okay, see, very simple. What you have to do now, year, dividend, then present value factor at, in tabular method if you put, okay, the KE, what is KE? 15%. Okay, then discounted cash flow or present value we need to find out. Either year D1, D2, 2 years dividend you will compute. Thereafter, okay, you have to compute P2, price at the end of year 2, which is the question. We will assume that this is 2-year holding period question, and in this case P2 is nothing but D3 divided by KE minus G. Already I discussed, correct? See, D3 by KE minus G, the second year cash flow, when you are computing price, okay, in case you are P0, if you are computing P0, I'll show it here. See what happens. If you are computing P0, then you will find the value by using next year dividend, next year cash flow. Okay, the D1 by KE minus G. In case you are computing P2, you should take D3 by KE minus G. All the logic, if you want to understand it detailedly, go to my equity valuation revision available in YouTube itself. There you can see how we have derived this formula, time value of money, entire thing, constant, geometrical progression, all these things I have discussed. Okay, now I'm just applying the formula and finding out the solution. So what we have to do in this current question, D1, D2 we have to find out. The D1, D2 growth rate is given, apply the growth rate and find out D1, D2. Then P2, okay, is nothing, P2 is nothing but price at the end of year 2. You will hold the share for 2 years, and at the end of second year, you will sell the share at the prevailing market price. The prevailing market, what is the value? Okay, fair market price at the end of second year, is nothing but, okay, D3 by KE minus G, which is, okay, which we will find out. So, and then you will discount D1, D2, P2 using all the present value factor for the respective year and find the P0 value of the share today. Shall we see? Question, they have also did the same. Okay, here, see what they have done, I've told you, they in institute module, some questions they have put it in tabular formula, tabular format, and some questions they have done it as such. So you need to understand, very simple, this first D0, first they have, yes, paid and they have given. I told you, MNP has declared and paid dividend, which means this is nothing but D0. Currently they have paid this much dividend. Okay, expected to pay na D1. Now they are telling that it paid 4 rupees per share as dividend, which means D0 is 4 rupees. D1 you will compute. D1 is nothing but D0 1 plus G. Agreed? Upper D0 1 plus G, 4 into 1.2, 20% growth rate. The first year growth rate you will apply. First 2 years they are telling that it will grow at 20%, right? So 4 into 1.2, 4.8. This you find out D1. By this you will find out D2 also. D2 is nothing but D1 into 1 plus G also you can do, or D0 into 1 plus G the whole square they have done is equal to 5.76. Upper D1 we have got D1, D2. Now D3 also we need to compute. Why? To compute P2. Are you understanding? For computing P2 terminal value they need to compute D3. For see, only when you compute D3 you can apply the formula D3 by KE minus G and you get P2 value. Then you discount the P2 and bring it to present value terms, year 0 terms, and find the present value of the share. See, very simple. D3 is nothing but, see, 4 into 1.2 the whole square, or simply 5.76. This we already computed. 4 into 1.2 the whole square, 5.76 into 1.1 is equal to 6.336. Correct? This is D3. Here 1.1 why they have done the third year, while you compute D3, you apply 10% growth rate. They have told third year growth rate changes to 10% and that stands forever. Upon 10% growth rate you will apply, you will find this should not, okay, this is, anyway, yes, they have computed P is equal to D1 by KE minus G. Very simple tabular formula. First year dividend they are using discount using first year KE. Okay, 1 plus KE. D2 1 plus KE the whole square plus TV. The TV it is nothing but P2, price at the end of year 2. Okay, we are going to find out it is nothing but D3 by KE minus G. Okay, 6.336 divided by KE minus G, you will get the solution. And of course, if you discount all these things, we have terminal value, either third year, second year discounting rate, here also second year discounting rate, and 4.8 dividend for the first year, you discount it using first year rate. Everything if you discount, you will get the value as 104.34. This is straightforward question. Next, question number 4. On the basis of the following information, current dividend is given, again discounting rate given, growth rate is given, calculate present value of the stock. See what D0 they have given, upper D1 you compute. Okay, D1 is nothing but D0 into 1 plus G, you will find D1, then D1 by KE minus G, assumed to be constant growth rate formula. Okay, constant growth rate you will apply and find it out. Now, see the second part, what they are asking in the second part of the solution. This is straightforward, first part. Second part, is it stock overvalued if the stock price is 35? See, now we have to find the value of the stock. Use the formula, find the value of the stock. Then compare it with the quoted market price. The quoted market price is 35 and compare the fair value of the share. Already we have found out. Then return on equity is 9%, EPS this much. Okay, show detailed calculation, use PE multiple approach, earnings growth model. See what we have to do, very simple. Earnings growth model we will find out, and then PE multiple approach we need to additionally find out. In the second question, first question, normal dividend growth model you will apply and then find out value of share. In the second part of the question, they have given the quoted market price and they have given additional data regarding equity, ROE and EPS. Okay, in order to compute PE ratio. PE ratio is nothing but 1 by ROE, and then they have given EPS. They have asked us to compute earnings growth model. What is the share price? Okay, and we will compare it with 35 and find there is any undervaluation or overvaluation, whether we will buy or sell the security. See, present value of the stock D1 by KE minus G, simply 30 rupees is the value. Now, value of the stock under PE multiple approach. PE multiple approach, very simple and straightforward. Actual stock price is 30, return on equity 9%, EPS this much. See, EPS they have given us 2.25, yeah. Very simple. I'll tell you one thing. Here, MPS as per the PE ratio approach is nothing but, okay, EPS into PE ratio. Correct? You already know that MPS is nothing but EPS into PE ratio. Up EPS they have given straight away. PE ratio they have given in the question, not given, not given. PE ratio is nothing but 1 by return on equity. 1 by return on equity. How this is arrived, I will show you very simple. See what happens. Okay, MPS is nothing but EPS into PE ratio. Correct? Appo PE ratio is what? You tell me. What is PE ratio? PE ratio is nothing but MPS divided by EPS. Agreed? Now, what is KE? KE, you have to find out now. See, I will tell you what is the value of the share. 1 second. See, P0 is nothing but P0, value of the share is nothing but constant earnings model. If I use, what I will get? Earnings, okay, divided by KE. Constant earnings model, earnings divided by KE, I will get as P0. This is on a per share basis, nothing but EPS divided by KE. Okay, this is constant earnings model. If I use, this will be the value per share. P0 is nothing but MPS. Correct? Upper simple, KE is nothing but EPS by MPS, which means KE is equal to EPS by MPS and PE ratio is equal to MPS by EPS. Now, to put it simply, okay, I can write as KE is equal to 1 by PE ratio. 1 by PE ratio. MPS by EPS is nothing but PE ratio, which means EPS by MPS is nothing but 1 by PE ratio. This is how you will get, okay, KE as 1 by PE ratio. Yes, it is stock. If the stock is overvalued with stock price is 35, okay, we'll see the solution here. See, so PE ratio 1 by return on equity they have given, okay, 1 by 9%. In this question they have given us 9%. Yes, return on equity is 9%, which is 11.11. Which is 11.11. What is the market price? Market price comes to 25 rupees, which means PE ratio into EPS, you will get the current market price. Next, value of the stock under earnings growth model. Value of the stock under earnings growth model. Actual stock price comes to 35, return on equity 9%, EPS is 2.25, growth rate is 2%. Okay, of course, EPS into 1 plus G, earnings growth model, EPS into 1 plus G, same way dividend 1 plus G, EPS 1. See, D1 by KE minus G is as per dividend growth model. Earnings growth model, EPS 1 into 1 plus, EPS 1 divided by KE minus G. EPS 1 is nothing but EPS 0 into 1 plus G divided by KE minus G. Okay, is equal to nothing but, you will get 2.25 into 1.02 divided by 0.07. Here, KE minus G is only computed as, see, growth rate 2% and the KE minus G is 9 minus 2% they have done. Don't think return on equity, I told you, interchangeably they will use the question return on equity as well as the KE. Okay, both means both are not same, but in this question they mean the same thing. Otherwise, return on equity is given as 9%. I also showed you, sir, KE and 1 by PE ratio you have showed. Now they have taken return on equity. Don't ask me, I will explain in the class, okay, clearly how they have given. So, in 9 minus 2%, 7% they have done. Are you understanding? KE minus G. Can you see this? They have taken KE, but actually they have put return on equity. So, I told you interchangeably they will use it. Next, hence, since the actual stock price is higher, the stock is overvalued in the market. 32.79 is the fair value of the share. Okay, and 25 is the fair value of the share as per P ratio approach as well as the earnings approach. So 32.79 is the price and the actual fair price, and the quoted price is 35, which means surely overvalued. Next, to come to question number 5. Question number 5. X Limited just declared a dividend of 14 per share. Mr. B is planning to purchase the share of X Limited, anticipating increase in growth rate from 8 to 9%, which will continue for 3 years. He also expects the market price of this share to be 360 after 3 years. you are required to determine the maximum amount B should pay for the shares. If he requires the rate of return of 13% per annum, the maximum price B will be willing to pay for the share. If he is of the opinion that 9% growth can be maintained indefinitely and require 13% rate of return per annum, the price of share at the end of 3 years, if 9% growth rate is achieved and assuming other conditions remain same as above. The questions that is being asked. Okay, present value factors, all these are given. See, very simple. The X Limited, the company has just declared dividend 14 per share, which means you tell me this is D0 or D1 or D0. Next, B is planning to purchase the share, anticipating increasing growth from 8 to 9%, which means existing growth is 8%. It will increase to 9%, which will continue for 3 years, which means, see, current growth rate is 8%, whether it is relevant or irrelevant or not relevant, future growth rate only you will consider, but 9% is the future. This 9% is permanent or only it will continue for 3 years, 3 years, which means for 3 years the dividend will grow at 9%. And at the end of 3 years, whether you are holding the share, you are going to sell the share, it is the assumption, which means, okay, this is to be taken as 3-year holding period. See, I have already explained that the share price, the value of an asset will never change with regards to the holding period of the asset. Holding period of the asset will never change the value of the asset as such. But, okay, in the question lab, wherever they have given, okay, assumed to be 3 years, they're holding the shares for 3 years, then at the end of 3rd year they are selling. Correct? We will assume the holding period to be 3 years, and at the end of 3rd year, the P3, see, very simple, if you are holding the share for 3 years, you will receive D1, D2, D3, and you are going to sell the share at the end of year 3, which I call it as P3, price at the end of year 3. Correct? You need to find all these, okay, and then discount and bring it to present value terms to find out the fair value of the share. Say, maximum amount B should pay for the share if he requires rate of return 13%, which means discounting rate is 13% KE, and if you bring all these value to present value terms, you will find the fair value. See, in this question, what they have done, year 1 D1, first they have found out D1, D2 and D3. KE at 13%, P3 they have found out, P3 is nothing but, you tell me children, what is P3? P3 is nothing but D4 divided by KE minus G. I told you the next year cash flow you will consider and then discount, because see, I will tell you what happens really. If you are holding the asset for 3 years, D1 to D3, okay, what is the value of asset? P0 is nothing but D1 to D infinity, which means from today till the eternity you will receive all the dividends, you discount all the dividends and bring it to present value terms, you will get the fair value of the share. But, okay, as per dividend model, correct? Here, but you are holding the share only up to 3 years, na? Up D1 to D3 you will receive as dividend, and P3 is there, na? P3 is nothing but D present value of D4 to D infinity, which means is nothing but D4 divided by KE minus G will bring all the future cash flows to present value terms, P3. D1, D2, D3 and P3, if you discount all this and bring it to present value terms, you will find the fair value of the share. See here what happens. D1 by first year 1 plus KE discounting rate, second year discounting rate you apply for D2, third year discounting rate you apply for D3, and P3 which you computed already. In the P3 is nothing but, okay, D4 by KE minus G, which they found out, yes, 360. How did you find this 360? D4 by KE minus G, but whether they have asked us to compute all this and nothing, no need to find, because market at the end of year 3 they have given, straight away they have given. Consider that here what they have given in the question, 360 they have given. Can you see this 360? Yeah, the 360 is nothing but P3. Okay, all this if you discount, you will get the fair value of the share as how much? 288.56. Next, if growth rate is 9% is achieved for indefinite period, then maximum price of shares should A willing be to pay. Very simple. If growth rate is 9%, it stays forever. Then we don't need to compute D1, D2, D3, okay, and the P3. Why? Because see, if the growth rate doesn't change, you can simply apply the formula today itself, dividend growth model. Very simple. P0 is equal to D1 by KE minus G. If you apply, okay, 15.26 by KE minus G, you will get the value as 381.5. Simple. Assuming that conditions mentioned above remain same, the price expected after 3 years. 1 second. What the part 3, second question we have solved. Part 3 of the question, we will see the price of the share at the end of 3 years if 9% growth rate is achieved, and assuming other conditions remaining same as 2. Okay. Yes, price of the share at the end of 3 years. See, what is the difference between Part 2 and Part 3? Part 2 they are asking us to find out P0. Part 2 they are asking us to find out P0, price today, willing to pay for share. Okay, this is today. What is this third part? Price of the share at the end of 3 years, which means they are asking P3. They are asking P3, not P0. Are you understanding? So what you should do, see here, if P3 is very simple, they have just simply applied D4 by KE minus G, D4 by KE minus G, and the 1.09 growth rate will still remain same. Up a third year dividend, okay, is a third year dividend you will consider D3 into KE into 1 plus G, you will get D4. D4 is nothing but D3 into 1 plus G. D3 you already have computed here, D3 as 18.13, okay, and 18.13 into 1.09 divided by KE minus G 4%, you will get 494. This is the price at the end of year 3. P3 they have asked to compute. Are you all comfortable? Everything we have discussed. Next question number 6. Piyush Lunkar and associates presently pay a dividend of rupee 1 per share and has a share price of 20. If this dividend were expected to grow at 12% per annum forever, what is the firm's expected required return on equity using dividend discount model approach? Expected or required return on equity. See, both expected rate, expected rate of return and required rate of return are not one and the same. Portfolio management, I have clarified, okay, they are not at all same. KE is required rate of return and not expected rate of return. Expected rate of return, what you will expect? You will expect extremes, average, this is called as mean return. Expected return, okay, you will compute mean return, average return only you will expect. But, okay, based on the risk perception, based on the risk of the securities, you will, okay, ask something over and above the expected return, mostly over and above the expected return, or if you feel that it is less risky, you can also ask less return. But required rate of return will be risk adjusted rate of return. This is required rate of return. Normally expected rate of return, okay, mean return is what you call it as expected rate of return. Institute module, ICAI Study Mat and examination questions I already explained in the portfolio management chapter also. Interchangeably they use expected return, required rate of return, but they are not one and same. They are different. So yeah, but this KE is nothing but required rate of return. That you should remember. The KE is required rate of return. So if dividend were expected to grow at rate of 12% per annum forever, what is the firm's KE, which is they are asking KE only in this question. Contextually you need to understand. In this question they are asking KE using dividend discount model approach. Very simple. Dividend discount model, P0 is equal to D1 by KE minus G you will use. Now if you rearrange it, KE minus G is equal to D1 by P0, or to put it simply, KE is nothing but D1 by P0 plus G. This you will get. Correct? Use this and solve the question. See. So what they have done, the first part, see, KE is equal to D1 by P0 plus G, simply straightforward. Okay, they have applied the formula and found out D1 is equal to D1 plus 1 plus G. Okay, D0 in this question also they are asking the presently pay a dividend of 1 per share, which means D0 they have given as 1, not D1. This you need to understand. Up D1 you need to find out, just apply the growth rate given and you will find 12% growth rate they have given. You will find out the KE is equal to, okay, 17.16%. Just apply the formula, you will get the K. Next to what they are asking now, next is important, mark it as important. Instead of this situation part 1, suppose that the dividends were expected to grow at rate of 20% for 5 years and 10% per year thereafter, which means what you have to do in second case, now what is the firm's expected or required rate of return? No, they are asking required rate of return, not expected, okay, or interchangeably they cannot use, it is required rate of return. They are expecting us to calculate required rate of return, which means they are asking us to find the discounting rate. Okay, very simple. I'll show you what is happening in this question. Usually what you do here, okay, cash flow I can write, or dividends, okay, in this case dividend is the cash flow, present value factor at some percentage, and discounting factor, present discounting, what is that, present value, discounted cash flow. See here D1, D2, D3, D4 and D5 and P5. Are you understanding? This cash flow you will consider, and then you will discount at some rate, okay, and find out the value. Find out the value is given and find out the KE they are asking. Discount at some rate, okay, you will get the value. 20 is the P0, Okay, what they have done, they have done the trial and error method. They have used a trial and error method and found out. Okay, trial and error method. First you take one number. Okay, initially 17.6 is the KE. What you do is that in this situation we will use trial and error method. First assume KE to be 18% and find out this will be the value 20.23. And okay, if the KE is 18%, 19%, this will be the value. And what you do the interpolation and find out the exact, equate the price P0, we know that it is 20, correct? Which means very simple, at KE of 18%, 20.23 is the P0, correct? If you increase the, I told you the KE or the discounting rate and the value will be inversely proportional. If you increase the discounting rate, the value will be reduced, which means here the KE is 20 point, KE is, if you increase the KE by 1%, okay, the price decreases by 12.23 minus 17.89. 12.23 minus 17.89. Okay, how much is that? 1 second, I'll calculate. $20.23 minus 17.89, 2.34, which means, okay, see, for every 1% increase in KE, I get value reduction of 2.34. You tell me from 18%, I need to increase the KE at 1%, more than that, below that, you see, I only need a drop of 0.23 from 20.23 to reach 20, I need a drop of 0.23 and not 2.34. Appa very simple. If a 1% increase, okay, gives me a drop of 2.34 in terms of value, how much I should increase from 18% base so that my my P0 comes to 20. How much you should do, very simple. 2.23 divided by 2.34. 0.23 divided by 2.34. 0.098, which means this is what you should increase and not 1%, which means 18% plus 0.09. 18.098% will be the KE and not 19%. Do the interpolation, they have found out 18.09 or 18.1%. 18.098, they have rounded off. They have rounded off and found out that 18.1% is the KE. Okay, please go through the solution. This is interpolation, they have done the solution. Okay, next. Take question number 7. Capital structure of Sun Limited as at 31/3/2003 was as under: equity share capital given 8%, preference share capital given 12%, debentures, reserves and surplus. This is one of the valuation based model, earnings based model. I will explain it before solving. Okay, once we read out the question, thereafter I'll explain what is the issue involved, then we'll move on to the solution. See, Sun Limited earns, these are all the number given, okay, balance sheet numbers are given, and Sun Limited earns a profit of 32 lakhs annually on an average before deduction of income, tax, which works out to be 35% interest on debentures. Okay, so before tax and debenture, 32 lakhs is nothing but EBIT. Normal return on equity shares of company similarly placed is 9.6, provided profit after tax covers fixed interest and fixed dividends at least 3 times. Capital gearing ratio is 0.75. Yield on share is calculated 50% of profits distributed and 5% of undistributed profits. Sun Limited has been regularly paying equity dividends of 8%. Okay, compute the value per share of the company assuming 1% for every one-time difference for interest and fixed dividend coverage, 2% for every one-time difference of capital gearing ratio. Okay, this is the question that is being asked. See, before solving the question, before looking to the solution, I will tell you a few things regarding valuation. So in this question, what they are trying to do, now I will give you an overview. What they are trying to do, okay, see, they are trying to use earnings capitalization model. Okay, P0 or fair value of the equity share is nothing but, okay, earnings by the company divided by KE. We already know, as per the constant earnings share valuation model, this is the formula, earnings divided by KE. Now see, the earnings na net profit after tax, profit simply profit after tax, okay, divided by KE, assuming this profit after tax will continue forever. This is constant, there is no growth involved. This is constant earning model. This is constant earning model. D by KE in one we saw na D by KE, like that. This is constant dividend model, like constant dividend model. This is constant earnings model. Now here, see, this can also be written as earnings by KE. Future earnings I can capitalize. This is what capitalization of the earnings. Or I can simply write on a per share basis. I can also write EPS by KE. Are you understanding? P0 is equal to EPS by KE. This also we can use. Now the question is nothing but asking about using this share valuation formula. They have solved the question. But in a issue, what is the issue? Na? The KE, okay, something similar to proxy beta we studied in portfolio management. Okay, the KE should be adjusted based on some ratios given, which means KE normally, assume the KE is 18%. Na? This KE as such you cannot take. Okay, you need to do some adjustments with regards to the company's debt equity ratio or company's interest coverage ratio. Like this, they have given some premium. Okay, it should be added to the existing KE. Up of a benchmark KE, okay, you will take, and then you will adjust the KE, okay, using the company's debt equity ratio or whatever data given as per the question. You should adjust the KE, and adjusted KE you will use and discount the earnings, future earnings. This is the question. Okay, there are adjustments which pertains to numerator as well as denominator. We will see it separately. See, now solution we can solve. See the solution here. Profit before EBIT given as per the data, 32 lakhs is given, and interest you will reduce the interest, 12% debentures on 64 lakhs. You will reduce the 7,60,000 debentures. You will get profit before tax. Then reduce the tax. You will get the PAT number. Are you understanding? Till now no issues. Now from the PAT, okay, see, EBIT belongs to 4%. EBIT belongs to 4%. I told you one is interest. Debt holders will take interest. Then okay, then the government will come and take the tax portion. Then you have preference dividend. Preference shareholders will take preference dividend. Then last finally equity shareholders will take equity dividend. Correct? Now you see till PAT you have you arrive at PAT of 15,80,000. From there you reduce the preference dividend. 40 lakhs into 8%, 3,20,000. Okay, then whatever is the available for equity holders, you will get the profit available for equity holders, a dividend distribution for equity holders. How much is that? Okay, you distribute 8% of the 80 lakhs balance. Okay, 6,40,000 you will reduce. So these two numbers you will reduce, and okay, you will get the retained earnings. You will get this number. Okay, 6,20,800 is nothing but retained earnings, which is undistributed profit. This is net profit after tax. From here I distribute something and then I retain something. Okay, how much is it? Or all these are relevant. This is number given, 9,60,000 you distributed, balance retained portion 6,20,800. Till now understood? Okay, now I'll come back to this discussion later. Before that we will use the adjustments given for KE. See, very simple. First they have given what they have given. Adjust the KE using these two data. First KE you should adjust. See, normal return on equity shares of the company. I am highlighting this. Normal return on equity shares of the company is 9.6%, provided. Are you understanding? Which means 9.6%. If nothing, okay, is given in the question, 9.6 as such you can take and discount the earnings. Correct? Now the problem is, okay, we have to do some adjustments. Here they have given, okay, regularly pay, compute the value, assuming 1% for every one-time difference for interest and fixed ratio. See, very simple. Normally, okay, at least 3 times it should be the okay, fixed interest and fixed dividend coverage ratio should be 3 times. Okay, it should be 3 times, right? Now if it is below 3 times, you will add a premium. It should be 3 times. Okay, exceeding, it should be below 3 times. What is adverse scenario? If it is this coverage ratio, see, coverage ratio is nothing but, okay, amount of profit which is required to cover the interest and dividend. Okay, ratio, formula and all we will see, that is not an issue, but it is the amount required to cover the interest and fixed dividend portion, which means if it is dropping down, okay, company will have risk. For this they are saying that you will, okay, add 1% premium for every one-time difference, which means if this 3 times is there, if one-time difference, okay, it is coming now, you will add 1% to the KE. This is what they are asking, because your company will be risky now. See, you have to have adequate cash, adequate profit to cover the interest as well as fixed dividend. If your company is not generating the profit which is being able to cover the dividends and interest, then what will happen? Okay, it will become risky. Yeah. For that risk premium, 1% they are asking us to cover. That is one thing. Then capital gearing ratio is 0.75. Okay, and for that also they have given an adjustment. Normally capital gearing ratio, preferred capital gearing ratio is 0.75, which means if this ratio is higher, in this case capital gearing ratio, like if the ratio is higher, more risky na. For a one time difference we will be taking 2%. For every one time difference we will take double the risk coverage, which means if normally K is 9.6%, if capital gearing ratio ideally 0.75 should be there, assume it is 1.75, then you will add a 2%. Okay, this just for discussion I am saying the number, we will see what it is. And yield on share, okay, see I told you the earnings per share, okay, is nothing but yield on share, which means earning per share basis. What is the yield? Yield on share is nothing but earnings per share. Okay, this earnings, distributed earnings as well as undistributed earnings, both we can consider. Okay, so this is the question. Now see how they are adjusting the KE, we will see. What first to compute the fixed dividend coverage, interest and fixed dividend coverage ratio computed. Very simple. We already know that interest coverage ratio, how to compute we know. The new thing, nothing but fixed dividend coverage, which means, okay, very simple. See, what is the amount which would cover interest as well as dividend? Okay, you need to see, very simple. If I take EBAT, I told you EBAT belongs to these 4%, correct? It will cover the interest portion, it will cover the dividend portion, but it will also cover the tax portion. But okay, that we don't require, what they are saying. So if you don't require tax portion, very simple, PAT belongs to all these persons plus debenture interest you add, correct? Debenture interest, okay, after tax, debenture interest 1 minus T, if you add from PAT, very simple, from PAT if you add a debenture interest and you remove the tax benefit arising from the interest, debenture interest, okay, you will remove essentially the tax portion. Are you understanding? This is the numerator. Okay, this is the amount which will cover, or I can simply, if I want to compute from EBAT, very simple, EBAT 1 minus T. This is also called as no PAT. EBAT 1 minus T will give you the same answer as PAT plus debenture into 1 minus T. Are you understanding what I am trying to say? Okay, this you need to compute. This divided by debenture interest plus preference dividend, which means you will get the coverage ratio, how much of the net profit. Okay, you need to find net profit. Okay, but from net profit you remove the tax effect. Okay, and the denominator, how much the interest and dividend is getting covered by the net profit. Are you understanding? This is what you need to find out. This ratio is nothing but what is this? Interest and fixed dividend coverage ratio, PAT plus debenture interest divided by debenture interest plus preference dividend. Okay, this you do 15,80,000 plus 7,60,000 divided by 7,68 plus 3,20,000. You will get the ratio as, okay, see here they have given a net of tax, debenture interest plus preference dividend 1.91. What they have solved here, yes, here, see, yes, 2.16. They have taken 2.16. That is what I was thinking. They have solved. Okay, you can also take it as 1.91 or 2.16. They are saying, but anyways, okay, this is the tax should be adjusted anyway. But they have solved, you can solve under both the methods, that is not an issue. Okay, so PAT plus debenture interest plus preference dividend. Okay, now here in this case they have adjusted for tax, this should be the correct method. Okay, but they also shown you the the ratio without adjusting tax. This is the ratio, okay, after adjustment of the without adjusting the tax, this is the ratio after adjusting the tax. This should have been the correct way, but again they have taken 2.16. Anyway, they have given both the method. I think they will allot you marks for solving both the methods, that's why they have given. But they have solved further while computing KE ratio. They have considered KE, the percentage they have they have taken 2.16 as the benchmark to be added. Sorry, calculation of capital gearing ratio. How capital gearing ratio is calculated? Now, fixed interest bearing funds divided by equity shareholders funds. See, we learned something called as a debt equity ratio. We learned something called as debt equity ratio is nothing but, okay, debt equity ratio there, what we learned there, see, very simple. See, capital gearing ratio, fixed interest bearing funds divided by equity shareholders funds, which means, see, preference share capital plus debentures divided by equity share capital plus reserves and surplus. In debt equity ratio, we used to compute debt by equity. Either numerator debt alone, debenture alone, okay, this portion alone we will consider. Here capital gearing ratio means they will also consider the preference dividend. They are also consider preference dividend preference share capital, preference share capital plus debenture, okay, divided by equity. You will get the capital gearing ratio as 0.93. Next, yield on equity shares. Yield on equity shares, how they have computed? Very simple. 50% of distributed profit, total profits they are computing. This is on a total basis they have computed, then on per share basis. In this question, they have not given you how many shares are allotted. See here, I'll show you. In this question, they have given anything about how many shares are outstanding, any data given or not given. Okay, see, what they have given is equity share capital 100 each. Yes, 100 each face value they have given in this question. Up 100 each, they have given the face value of this share. Up a number of shares you can compute, no issues. Assumed 100 to be the face value. Okay, number of shares you can compute. Up first total distributed profit you need to compute now. How much is that? See, for computing yield, in the one more thing is there, yield there is adjustment. I don't take, as per this model, I don't take the total earnings. Of course, I should take the total earnings. This is, I can fix in such a way, okay, valuation need not be, it depends on person to person, they can change the valuation method. Here they are saying the yield on equity shares is calculated 50% of the profit distributed. See, I'm not taking 100% of the distributed profits as well as undistributed profit. Simply you can take the PAT itself. Now, what they are saying, I am only considering numerator we need earnings to find the value of the share, earnings divided by KE. KE we have 2-3 adjustments given in the question. 2 adjustments given in the question that we will consider and adjust the KE. Correct? 9.6 is the KE. That we will adjust and revise KE we will find out. Numerator earnings is to be computed now. Here earnings, the total earnings available for shareholders we will not consider. Okay, what we will say in the earnings lay 50% of the distributed profit I will consider and 5% of the undistributed profit for valuation. These are all valuation based method. Okay, I can use any type of value. Here I am using this method to value. There is no hard rule that only you should value this much. Ad hoc basis, this company is being valued by taking 50% of the distributed profits and 5% of the undistributed profit. Okay, now since they have mentioned it, we are taking that for valuation numerator. So 50% of the profit comes to, distributed profit comes to 3,20,000, undistributed profit comes to 5% of undistributed comes to 31,040, total 3,51,040. Now we need to compute yield on equity shares. Yield on equity shares is nothing but, see here, 3,51,040, correct? If you do it on a per share basis, or okay, see, if you do it on a per share basis also, you can find out EPS. What is the EPS? Please tell me, children. Okay, 8 lakhs divided by 8 lakhs, 3,51,040. 1 second, 3,51,000. I'll take a calculator. 3,51,040 divided by 8 lakhs. How much you are getting? 0.4388. Okay, 0.4388. Okay, this number I am getting. Are you all understanding? Okay, this is the earnings per share. Assume this is earnings per share to be considered in the numerator. Forget about the presentation. What they have done now on a total share capital basis, okay, they have computed 4.39% into 100 in percentage terms they have computed. Okay, what is this amount with respect to total equity share capital? Are you understanding? Now, okay, per share basis, you remember that it is 0.4388. So presentation difference, I'll tell you, nothing big. Okay, you will understand. See, now calculation of yield on equity shares, expected yield, this you need to discount the earnings. Okay, what is the discounting rate you should consider? They are saying, see, very simple, risk premium 3. For 3%, what they have told, if it was 3%, what is that? First, come to interest and fixed dividend coverage ratio. It is 2.16 times, but okay, the industry average is 3 times, which means the sector average or industry average is 3 times. And you tell me if my coverage ratio is 2.16, is more risky or less risky? More risky, because higher the coverage ratio, lesser the risk. Less the interest coverage ratio, okay, your risk will be higher, which means 3.3% minus 2.16, your coverage ratio is only 2.16%, which means you have to add premium to discount. The difference is 0.84. For every 1%, I will add 1%. They have told every one time 1% they will add. Correct? Which means for every 0.84, you will add 0.84% to the 9.6. 9.6 is the original number, KE, plus 0.84 you will add. Come to the second adjustment, capital gearing ratio adjustment. Here you see we have found out it is 0.93. Here industry average is 0.75. We will add 2% for every one time difference. How much is the difference? Very simple, 0.75 minus 0.93. Here also you need to think whether I need to add or deduct. Okay, don't think every time I need to add or every time I need to deduct. No hard rule. You need to compare. Very simple. You think about it. Capital gearing ratio. Higher the capital gearing ratio, less riskier. Lower the capital gearing ratio will be riskier. Higher the capital gearing ratio, it will add up to the risk. Which means the capital gearing ratio is nothing but like debt equity ratio. Which means the company is more risky. If you keep on adding the debt, it will be more risky. So here 0.93 is the current debt capital gearing ratio. Preferred capital gearing ratio is 0.75, which means it is more risky. The differential amount comes to 0.18. This 0.18 you multiply it by 2%, 0.36% you need to add. Again, higher risk you need to add. The total comes to 10.8%. 10.8% is the KE. Now value of equity shares, very simple. This is on per share basis. If you see 0.4389 something we got divided by 10.8%. I'll just compute. Very simple. We have done a mistake here. What happens? 0.4, the number of shares outstanding is not 80 lakhs. The number of shares outstanding is not 8 lakh, it is 80,000. 80 lakhs divided by 100, it is 80,000, which means 3,50,000. Here we have no issues. 3,51,040 divided by 80,000. 80,000. How much it is divided by 80,000? How much is the number? 4.388. This 4.388, if you discount, 4.388 by 10.8%, how much it is? Are you all getting 40.65? 40.65. This is the value per share. Take question number 8. Next question number 8. ABC Limited has been maintaining a growth rate of 10% in dividends. The company has paid a dividend at 3 per share. The rate of return on market portfolio is 12%, and the risk-free rate of return in the market has been observed to be 8%. The beta coefficient of company is 1.5%. You are required to calculate expected rate of return of the company shares, EAPM, and equilibrium price per share by dividend growth model. So very simple. They have asked us to compute expected rate of KE. They have asked us to compute. Use this KE to use dividend growth model D1 by KE minus D and find out the value per share. Very simple. RF plus beta into RM minus RF. Beta expected return. This should not be expected return. This is required rate of return. Anyway, KE is equal to RF plus beta into RM minus RF. They have found out the KE as 14%, and applying this KE, you equate this KE and find out the P0, or you can simply write P0 is D1 by KE minus G. D1 by KE minus G. You can apply the formula and you will find out the price of the share. Nothing, straightforward question. Next, question number 9. A company pays a dividend of 2 per share with a growth rate of 7%. The risk-free rate is, the question number 7 which we discussed, mark it as important. Very, very important. A unique type of question. You may not understand why they have done like this. The logic also given. It's an earnings based model only, but earnings and the required rate of return, I did some adjustment and then find out the adjusted value per share. Set that the market as important question. Question number 7. Question number 9. A company pays a dividend of 2 per share with a growth rate of 7%. The risk-free rate is 9%, and the market rate of return is 13%. RM is given. Whenever the question gives you market risk premium, then it's already RM minus RF. When the question mentions just simply market return, it is nothing but RM. You have to reduce the risk-free rate to arrive at the premium. The company has a beta factor of 1.5. However, due to decision of the finance manager, beta is likely to increase to 1.75. Find out the present as well as the likely value of the share after the decision. This is a question that is being asked. Very simple, straightforward. First, present beta you used and find out the value per share. Then revised beta 1.75. Okay, since they made a decision which is risky and the beta increased. Now using the revised beta, what is the valuation? Very simple, straightforward only. Same formula you will apply and find out. Okay, question number 9 la existing. Okay, you will get the K as 15% and substitute the number, you will get the value as 25 rupees. Here, alternatively, it can also found out because see in the question, let D1, D0 is no clarity. Company pays a dividend of 2 per share with a growth rate of 7%. Now, it should ideally be taken as current dividend, D0 only. Correct? That is why they have come up with a solution, revised solution, alternative solution, which means the earlier situation, the 2 is taken as D1. But it only says some question, there is no pays dividend, it should be always, currently it is paying dividend, that is the meaning, which means D0 will be there. Okay, you need to compute D1 for applying the formula, hence alternative solution is also possible, they have shown, but always use this method because wherever they use pays dividend, you should assume D0, compute D1 and find out the value, 26.75, you will get the value. Now KE in a changed scenario comes to 16%, why beta changes, beta 1.75, what is the K you will find out, then value per share as per the revised K, very simple and straightforward. Okay, go through 23.78, simple only. Next question, calculate the value of the share from the following information. Okay, all this data given, profit after tax of the company 290 crore, equity capital of the company 1300 crores, par value of the share 40 each. Yes, par value of the share that you need to, okay, notice debt ratio of the company, debt divided by equity plus equity. Okay, this is a debt ratio. Debt ratio, not debt equity ratio. Debt, that's why they have given, even if they have not given, you should understand it is debt divided by total assets, which means debt divided by debt plus equity, 27%. Debt ratio, simply debt ratio. Long run growth rate of the company is 8%. Beta 0.1, risk-free interest rate is 8.7%. Market returns comes to 10.3%. Capital expenditure per share. Depreciation per share is given. Capex per share 47, depreciation per share 39. Change in working capital also on a per share, yes, per share basis they have given as 3.45. So all these data are given and we have been asked to find out the value per share. Sir, how can I find out the value per share? Na? See, very simple. Okay, if this data is given, you should understand that your capex, depreciation, change in working capital, all these where you will learn free cash flow model. Free cash flow to equity, you need to find out, assume, you need to find, this is a shortcut formula given for free cash flow to equity. Okay, how to find out, I'll tell you, very simple. See here, while computing the free cash flow to equity, I'm highlighting the formula. See, I'll explain you what it is, everything. See, free cash flow to equity, how to compute free cash flow to equity? Now, very simple. First, you will compute the free cash flow equity of the company. Then you discount using normal, you will get the current free cash flow to equity, just like dividend model. See what you do, D1 by KE minus G you will apply. Yeah? Same way, free cash flow to equity 1 divided by, okay, KE minus G you need to find out. Correct? Are you understanding what I am trying to say? Free cash flow to firm based valuation model. Now, free cash flow to firm divided by KO minus G we will use, correct? We will use overall cost of capital or WACC, okay, to discount back find the value of the share as per the FCFF approach, correct? FCFE, you find out FCFE, then discount, while discounting it, okay, while computing the value per share, you will use KE for discounting and not KO. Are you understanding? Here, first, first, for that to happen, first you need to compute FCFE, right? Current FCFE you need to compute, then FCFE1 you will adjust the growth and find FCFE1 and find out the value. Here FCFE, how to compute FCFE from PAT? Okay, we used to compute PAT, okay, plus, okay, depreciation you will add back, correct, minus change in, okay, or investment in fixed assets minus change in working capital. This you used to do on a total basis when you compute FCFE from PAT, correct? But institute has used one shortcut formula. This is, see, the solution will not, if you do using this formula, it will not give the same solution. I'll tell you the reason. Okay, we don't want to get into deep into the concept. Understand that this is a shortcut formula. Just like in YTM, we compute, okay, approximate YTM using shortcut formula. Like this, we use the debt ratio and find out the approximate FCFE, which is enough, more or less it would be same. Okay, that because FCFE for computing the absolute number, we need to do a lot of adjustments. Just to apply the debt equity ratio, you cannot find out debt ratio, you cannot find out the FCFE, real FCFE, because balance sheet okay, net profit after tax will require a lot of adjustments. We used to, in our regular batch, we used to do one comprehensive question which covers all the aspects of the balance sheet that we are not going to discuss here. What I am trying to say is, okay, this is a shortcut formula which is used by the institute where they have given per share basis. On a per share basis, you need to compute FCFE, just like EPS, okay, in the numerator, FCFE per share we need to compute. Now, this is the shortcut formula they will use. What is this? This is just a replacement of this. I'll tell you how it is, very simple. You see, you have PAT available. In the PAT, I call it as what is per share basis. This PAT is nothing but EPS. Are you all understanding? If I use this PAT on a per share basis is nothing but PAT divided by number of shares. What is that? EPS. Correct? The plus depreciation, change in fixed assets, I cumulatively I call it as, okay, change in net fixed assets. Okay, the depreciation and the fixed assets I can combine and can tell that it is net fixed assets. Agreed? Either depreciation per share, change in fixed assets per share. Okay, here, see, one more thing is missing. I'll come back to that. Last, I have one more adjustment to make, that is plus net borrowings. Net borrowings in case of FCFE. Okay, I have not told you yet. I will adjust at the appropriate time. You understand that FCFE computation, from PAT you need to compute FCFE. How will you compute? See here, from PAT you need to compute FCFE. Now PAT plus depreciation minus change in fixed assets minus change in working capital. Okay, plus net borrowings or minus if net repayment of borrowing. Okay, this is there. Net borrowings, if it is additional borrowings, I will add. If it is net repayment, I will reduce. If there is only repayment, I will reduce. This is there. This is FCFE from PAT. Now per share basis, you see what happens. I divide PAT by number of shares, I get EPS. Correct? And depreciation per share is there, plus depreciation minus change in fixed assets. Okay, I can write it like this. Okay, I can cumulatively write this as, see, what I can write is capex minus depreciation, C minus D I can write. Can you all understand? Minus D na, see, this is capex, this is capex, minus depreciation, what I will get? Net capex. Either anyway I am going to reduce from PAT minus this number. One adjustment is that, okay, I use borrowings now. The borrowings I adjust in this and I adjust this working capital. So borrowing ratio, assume of the company, out of the total, the capital structure of the company, assume I am taking 27% debt. I am taking 27% of my, asset as debt. Now the 27%, okay, I can adjust to net fixed assets and net working capital. On a per share basis, I will get the amount. How to adjust? Very simple. 1 minus, FCFE na, 1 minus borrowing rate. 1 minus borrowing rate. 27% is debt holders amount, share. That you will reduce because we are computing FCFE, FCFE. For computing FCFE, you need to adjust that portion of the cash flow which doesn't belong to equity holders, correct? Effectively 1 minus B, if you multiply the 1 minus B into net fixed assets, you will effectively get the net investment in fixed assets which belongs to equity holders alone, Same way, minus 1 minus B into net working capital. You have net working capital. 27% of the working capital belongs to borrowers. So that I will adjust. Whatever working capital belongs to fresh investment in working capital belongs to equity holders alone, I will consider. Are you understanding? This is the crux of the formula. Now tell me, what is the formula? Net income, they have taken per share only. This is nothing but EPS. Okay, net income you should not write, EPS you write. Okay, the module also EPS given. Very simple. Given net 8.923 is nothing but EPS. They have computed EPS 8.923. Okay, first step in 1300 crore share capital divided by par value, face value, you will get the 32 number of shares outstanding. Then you will compute the EPS. Then apply the formula. Very simple. All the other data given. Debt ratio given 1 minus B in borrowing ratio. That is why they have given us B. 1 minus B. All the data given. You solve the you will get FCFE as 5.5645. This is the FCFE. You will compute the FCFE. Then you will find KE, data given for computing KE, RM, all these data given, RF, all these data given. Now you find FCFE into 1 plus G. FCFE1 you need to find out. D1 by KE minus G, like that. FCFE1 by, okay, KE minus G, you apply the formula, you will get 70.89. This is a question that is being solved. Next, market as important, very, very important question, regularly asked in the examination also. Okay, this question is important. Next, question number 11. Shares of Voyage Limited are being quoted at a price earning ratio of 8 times, P ratio of 8 times. The company retains 5 per share, which is 45% of its earning per share. 5% is the retained portion per share basis. Okay, that is representing 45%. Okay, so we will get the earnings per share divided by 5 divided by 45%, you will get the total earnings per share. You are required to compute the cost of equity to the company if the market expects a growth rate of 15% per annum. If the anticipated growth rate is 16% per annum, calculate the indicative market price with the same cost of capital. Okay, this is the question. Okay, third part is also there. If the company's cost of capital is 20% per annum and anticipated growth rate 19% per annum, what is the market price per share? This is sensitivity analysis. They are changing various data and ask us to compute a price per share. Very simple and straightforward only. Okay, see here what happens. Cost of capital, first you need to find out K. Retained earnings 40% comes to 5 rupees. What is the dividend? 6.11%. What is the total? You need 5 divided by, okay, 45% will give you 11.11. This is the EPS. This EPS, 45% is retained, 55% is payout ratio, which means 6.11 is the dividend per share. Agreed? Now, you have EPS into PE ratio, which will give you market price as per the price to earnings model. Now, cost of equity capital, how to find out cost of equity capital? Very simple. Okay, I have 6.11. KE is nothing but D by P0 plus G. Agreed? This also, okay, we can find out 6.11 by P0, 88.88 plus 15% will give you the K. They found out the K. So first you find out the market P0, then you find out the K. Okay, then they have asked the second part. This is the routine computation only. Okay, growth rate given, routine. Next computation, if the anticipated growth rate is 16%, growth rate instead of 15%, you change the growth rate to 16%, and find the market price with the same cost of capital. Okay, same cost of capital, you change the numbers alone. Very simple. D by KE minus G. Okay, here alone the question is not giving us much clarity. See, 6.11 dividend K. See, 1 second. The D1 by KE minus G is the dividend growth model, which means the growth rate is given in the question, clearly given in the question. Correct? Wherever growth rate is given in the question, okay, it can never be D by KE minus G. Are you all understanding what I am doing? Say, this is constant growing model. This is called as constant growing approach, which means constant growth model. You cannot, okay, put the numerator simply dividend. It should be the first year dividend. The starting point should be the first year dividend. Okay, it cannot be D0, D1 it should be. This question, again, there is lack of ambiguous question, because what they are saying, company retains 5 per share, and this is 40% of its earnings per share, which means they are giving the current data. This by reading the question simply, okay, we can understand this is the current data. Okay, then in the previous question, Mary, you need to understand that you need to take D1 only, but they have solved this alternative solution also possible. Why I am saying this? Ambiguous question, alternative solution also possible. We can also say take 6.1 plus G also is possible. That is the issue. Next, see. Market price is there, and yes, second part, yes, 6.11 divided by KE, you replace it 21.87 minus 16%. Instead of 15, use 16% and find the value of the share. Okay, now next, market price is 20, yes, 20 is the, what do you say, they have given, KE is 20%, yes, third scenario, KE is 20% and growth rate is 19%. What is the value? Okay, per share 611, you get the number. This is a simple straightforward question, but of course market as important, routinely asked question, market as important. Next, question number 12. Following financial data are available for PQR Limited for the financial year 2008. 8% debentures, okay, 10% bond, equity, shares, reserves and surplus, total assets. and total assets, yes, assets given, assets turnover ratio, effective interest rate is given, effective tax rates, operating margin, dividend payout ratio, current market price of shares, required rate of return of investors. Draw income statement of the year, simple and straightforward. Calculate its sustainable growth rate of the earnings. We are going to see, very, very important. Calculate the fair price of the share using dividend discount model. Of course, you will find the G from here and you apply the sustainable growth rate to the D1 by KE minus G and find out the value per share. What is your opinion on investment at the current price, which means the share is undervalued or overvalued, whether it is recommended to buy the share or sell the share? This question that is being asked. Okay, simple and straightforward only. From first asset turnover ratio given a total assets. Now asset turn, you need to find out turnover. Total turnover comes to 660 lakhs. Okay, now effective interest rate is how much? Interest by liabilities na 8%, which means liabilities would a total 125 lakhs, 50 lakhs. We already saw that. Liability, they have given 125 lakhs consist of debentures. Okay, and there is a bonds also consist of 50, consisting of 50 lakhs. Correct? Here total liability comes to 175 lakhs. This liability, effective interest rate is 8% per annum. That also they have given effective interest rate. They have given here. Can you see this? This is effective interest rate they have given. This you apply on total. Why? Because okay, 8% debentures carry 8% interest, this interest 10% bond, so interest varies for various instruments. Effective interest rate they have given, straight away take that and solve. Otherwise you compute for everything. Okay, you will 8% debentures, what is the amount? Okay, 10% bond, what is the amount? Like that you need to compute, but they have given effective interest rate as 8%. Simply you will apply this to total liabilities, 175 lakhs. You apply 8% to that, you will get the interest expenses 14 lakhs. Operating margin 10%, of course. Operating cost this much. Okay, this is to find out what is the operating profit. Okay, operating profit, we need to adjust the operating cost. That is what. Okay, simply you can even apply 10%. You see here, okay, sales is 660 lakhs. Okay, operating expenses to show for the presentation only, just to compute EBIT. From EBIT also you can start anyway, no issue. EBIT also you can say 660 into 10% directly you can also compute and start the income statement from EBIT, no issues. Then dividend payout ratio 16.67%, tax rate is 40%, tax rate is 40%. Now you see that EBIT given, interest we calculated, EBIT, tax rate 40%, EAT, dividend at 16.67% on the equity shares, you'll get the retained earnings. This is the income statement, first part of the solution, simple and straightforward. Next, SGR. Okay, it is nothing but ROE. See, first ROE into 1 minus B. Now ROE, what is the ROE? We need to find out. Okay, what is ROE? Very simple. See, PAT by net. See here, what is balance sheet is given. Yes, return on equity, you will consider these two items. See, return on equity, how return on equity is computed? Very simple. Return PAT divided by equity. Simply I call it as equity, whereby equity share capital will also be considered and reserves and surplus will also be considered. So 100 plus 300 they will consider. Okay, 400 is the denominator. PAT to 31.2 lakhs. Here, how much you are getting? Return on equity is 7.8% into 1 minus B. Here 1 minus B is there. 1 minus B in the formula is borrowing ratio, the FCFE computation. Here 1 minus B is nothing but retention ratio. Okay, G we compute B into R. Are you all understanding? That we compute same thing only. Here this B is nothing but okay, retention ratio. Retention ratio in the question. Okay, how much is the retention ratio? See, what is the retention ratio? See, 1 minus B in they found. Yes, 1 minus B in, see, 1 minus it should be, yes, retention ratio. What is the retention ratio? Dividend payout ratio is how much? 16.67% is the dividend payout ratio. 1 minus 16.67%. How much it is coming? Okay, 1 minus 0.16.67. 83.33% is the dividend payout ratio, is the retention ratio. Okay, simply 0.8333 into the rate ROE. Okay, here R is nothing but ROE. I explain all this in, okay, you can go through the revision. YouTube also I have uploaded the revision of equity valuation chapter. There I have discussed under Gordon's model, Gordon's growth model, they have discussed in detail what is the logic of it, everything I have discussed. Interchangeably they use that. Say R is how much? 0.078, 7.8 percentage, na? Correct? Okay, this you will find out. And how much you are getting? Very simple, how much you are getting? 7.8 percentage into 0.8333, 6.95 percentage. Okay, 6.499 percentage, 6.5 percentage, 6.5 percentage. Here what they have given, 1 minus, okay, this you follow, this you don't need to follow. The 6.5 percentage is the okay, growth rate is SGR. Okay, B into R. Simply G is nothing but B into R. R is retained return on equity and B is retained earnings. Okay, return on equity you compute by applying this formula, PAT by net worth. Net worth is nothing but equity share capital plus reserves and surplus. Okay, calculation of fair price of the share using dividend discount model. P0, again you apply this growth rate, you found out the G, na? In the G you apply the growth rate formula, growth rate to the current formula. Okay, see, first you need to find out dividend. Current dividend is how much? 0.52. Okay, then growth rate is 6.5 or 6. Okay, they have presented under both the methods. No issue. Take 6.5. We will be awarded marks. That is perfectly fine. 0.52, 1.065 divided by 0.15 minus 0.065. You get the 6.51. Okay, or 6.91. There's a second that you don't need to consider. 6.51 is the correct answer. Next, since the current market price of share is 14, the share is overvalued. Hence, the investor should not invest in the company. See, very simple. The current market price is 14, and you found out that what is that? Okay, you found out the fair value of the asset is only 6.51. Okay, the fair value of the asset is only 6.91, and in the market it is trading at 14. It is overvalued and hence not recommended to buy the share. This is the question number 12. This question number 12 also you can mark it as important from this segment, equity share segment, equity valuation segment. Question number 13. Okay, can you see the question, or I need to zoom out, zoom in? 1 second. Okay, this is nice. See, okay, take question number 13. We are going to discuss question number 13. Mrs. X Limited has paid a dividend of 2.5. You tell me D0 or D1 or D0 per share on a face value of 10 in the financial year ending 31st March 2009. The details are as follows. Current market price per share is 60. Growth rate of earnings and dividend is 10%. Beta of the share is 0.75. All the data given. Okay, and average market return, risk-free rate of return, calculate intrinsic value per share. P0 is D1 by KE minus G. KE you need to compute, beta given, okay, and current market price is given, okay, to compare. Current market price is given to compare it with fair value and find out the solution. Okay, intrinsic value D1 by KE minus G, you compare 78.57. Okay, anyway, you need to comment, na? And calculate, yes, only calculation, but of course market price is 60, the fair value is 78.857. This is undervalued and recommended to buy the share. Next, question number 14, simple straightforward question only. Question number 14. Mr. A is thinking of buying shares at 500 each, having face value of 100. He is expecting a bonus at the ratio of 1:5 during the 4th year. Annual expected dividend is 20%, and the same rate is expected to be maintained on the expanded capital base. He intends to sell the shares at the end of 7th year at an expected price of 900 each. Incidental expenses for purchases and sale of shares are estimated to be 5% of the market price. He expects a minimum return of 12% per annum. Should A buy the share? If so, what maximum price should he pay for each share? Assume no tax on dividend income and capital gain. This is a question that is being asked. See, very simple. 500 each, having face value of this. He is expecting a bonus share. So what we will find out now? We need to find out fair value of the share considering these data, considering the bonus issue and other details. This he is holding, see, very simple, 1:1 the 4th year, yes, and the same is rate is expanded, intend to sell the shares at the end of 7th year, sells the share, okay, at the end of 7th year, which means very simple, we need to compute, okay, say, we will assume that the price is, the holding period is 7 years, we will compute the share value as per the 7 years holding period model, which means you assume you will receive 7 years dividend, as well as at the end of the 7 years you will receive the price, okay, current market price prevailing at the end of 7th year. Then you will consider D1, D2, D3, D4, D5, D6, D7, P7 and discount all these cash flows and bring it to present value terms. But dividend alone, okay, it will undergo a change due to the bonus issue. Bonus issue, na, there will be, dividend, more dividend you will receive, na, correct? All these adjustments, the 4th year, you are going to receive extra dividend because of the bonus issue, right? So very simple. See, KE 12%, they have given the question, yes, he expected minimum return of 12%, required rate of return is 12%. Upon 12% KE, you will discount all these cash flows. First D1 20, 20, 20. From 4th year, okay, it includes due to bonus ratio. Very simple. What happened? 1:5 is the bonus. Till now, you are receiving face value 100. Na? 20% is the dividend given. Okay, 20% is the dividend. Now, what happens? Due to bonus issue, 100, 500, face value is 100. Okay, which means bonus issue. Now, what will happen? You tell me, for every 5 rupees, you are receiving dividend of how much? 1:5. Na? Currently, you are holding 5 shares. Assume dividend is 20 rupees. Na? Dividend is 20 rupees. Okay, which means now, if you hold one more share plus 1 share, instead of 5 shares, you are holding, you are having 6 shares. Each share you are getting a dividend of 20%, which means extra 4 rupees, okay, 1:5 na, that you apply to the existing dividend. Upon dividend is 20, till now you are receiving into 1/5. How much is that? 4 rupees. This 4 rupee extra dividend every year you will receive after the 4th year, from the 4th year, I should say. Okay, see here, 24, upon 20, 20, 20, then 24, 24, 24, 24, till the 7th year, you receive this. Price at the end of 7th year, what happens? You tell me, children, what they are expecting. Their expected price at the end of 7th year is 900. But there are some adjustments to be done. The 900 share price is there. Okay, here, what is happening? You see, 900 is the price. But apart from this 900 price, what happens? Okay, yes, incidental expense you need to adjust, that is there. Apart from that, okay, the bonus shares, see, initially you would have some number of shares. Okay, 20% there has been addition. 1:1/5 is nothing but 20%. Apo, the number of shares will be increased, correct? Initially you will be having some number of shares today. But after the end of 7th year, okay, the 20% increase in number of shares will be there, correct? Upon 900 is the current market price per share, na? Okay, that also will increase by 20%, na? That is what the current share price, 900, will also increase, corresponding increase will be 20%. Upon 900 plus 900 into 20%, okay? This you should do, okay? This will be the corresponding increase in the price, okay? See, then what will happen? You will have the sale value. How there you reduce the expenses, 5% expenses, na? 95% will be the balance amount. Hence, this will be the, okay, sale value per share basis. What is the market price per share? Okay, after deducting expense, that only I will receive, na? That is the cash flow. Okay, present value of all the future cash flows. Now, whatever you receive, that only you will consider. Then you discount the same discounting rate at 7%, you will get the value. How much is the value? 563.68. This is the value, okay, of the share. This is not at the end of 7th year. This is P0, V0. This is value, fair value today, 563.68. Now, this, anyhow, the cost of share is also there. You see what happens. The cost of share is also to be adjusted, because today you are buying it for 500 and they have given that this will be the 5% charge will be incurred for purchase as well as sale of the shares. Purchase and sale of the shares means, okay, here when you purchase the share, there also you need to incur this 5% charge, which I will add. I have to pay 525 rupees to acquire the share. Apo I can buy the share at 525, okay, inclusive of all the expenses, and I will receive the value of 563.68, which means I make a net gain of 38.68. What is this? I will tell you. See, very simple. Mr. A is gaining 38.68. He should buy the share, but what is the maximum price he should be willing to pay? Na? There is a catch here. Maximum price is 563.68 only, which will include incidental expenses, which means, you see, 563.68 is the maximum price I can, this 525 rupees which you got today, na, the cost, this can maximum increase to 568.68. Otherwise, okay, I will incur loss. No point in buying the share. Are you listening? So, inclusive of expenses, the maximum price should be 568.68. Okay, upon expenses, if I reduce the expenses from it, I will get the quoted market price, which I should be bought without considering the expenses. Upon maximum price should be 563.68 into 100 by 105, which means the 568.68 inclusive of 5% of expenses cost, which means upon the number should be, okay, into 100 by 105. This is what this represents 105%, which means what is the 5% and what is the, sorry, yes, see, one second. This represents the 105%, which means above, what is 100%, then this is 536.84, which means 536, if the market price of the share is 536.84, okay, then only I can buy. Above this price, I cannot buy the share because I will incur also extra 5% charges, which will take me the total cost over and above 563.68, which is not at all feasible. That is why the maximum price affordable is 536.84. Very, very important question. I think this is very, very important. Question number 14 is important. Adjustment you need to remember. Question number 15. Okay. The risk-free rate of return, simple computation only. Okay. The risk-free rate of return is 9%. Expected rate of return on market portfolio is 13%. The expected rate of growth for the dividend of Platinum Limited is 7%. The last dividend paid clearly given, D0 as 2 and beta given. All this they are given to compute K. What is the equilibrium price of the equity stock of Platinum Limited? How the equilibrium price change when the inflation premium increases by 2%, the expected growth rate increases by 3%, beta of Platinum Limited equity shares to 1.3%. This is a sensitivity analysis question. Okay, they are changing the data and how share price is reacting, you need to find out. Okay, here earlier the institute had given, okay, the solution considering these three data to be a separate data, which means the 2% if inflation premium is changing, then assume that the growth rate and the beta will be same. Okay, and if you expect the growth rate increases by 3%, other data will be same, beta and the inflation premium, everything will be same. Okay, and here only here they have shown you various presentation of this question because there is ambiguity. Ambiguity in the sense, see, they have given inflation premium. They should have directly given risk premium. Okay, why there is they have considered the okay, there is a concept called as international Fisher effect, wherein the discounting rate represents a risk, the interest rate in the market represents a risk as well as inflation premium. It will consider risk premium, it will have risk premium as well as inflation premium, but okay, it cannot be directly taken as interest rate changes. Okay, it cannot be just taken as risk premium alone. Inflation alone they have asked, so risk you cannot directly adjust. This is why they have given an alternative solution also. Okay, anyway. Sorry. Expected growth rate increases by 3%, beta premium increases by 1%. What they have done now, the first part of the solution, no issues, find out the value of the share. That is not an issue, correct? Okay. Second part of the solution, They have shown an alternative way using all the data they have solved. Using all the data, which means earlier beta was 1.2, at present beta is 1.2, this changed to 1.3. Okay, inflation changed to 2%. Growth rate changes from 7% to 3%. All this cumulatively I will consider and find out the value. This is the alternative solution given. Earlier they used to find everything separately. That too, when one is being asked, all the other, it is assumed that all the other data is remaining constant. Okay, this might be confusing. I am explaining now itself so that you will not get confused while seeing this suggested answer. See what they have given. 15th question. Okay, first they have by default they have computed the fair value equity KE they have computed, found out the current value. That is not an issue. The second part is the trouble here. What they have done initially is that, you see, first way. Okay, there are so many alternatives. I will explain each and every alternative. You can present as, you can show it as per your convenience. It's not an issue, since they themselves have given, there is ambiguity in the question, so they have given alternative solution, no issues. But you should write the note that I have assumed like this. This clarity should not be there. Otherwise, the examiner will not know you have done knowingly or unknowingly. That should not be there. You should not have ambiguity. Okay, question might have ambiguity. You should write note properly and explain things. See what is happening. Here, inflation premium, leave it, beta 1.3 and growth rate 3%. Now growth rate is 3%, growth rate is 10%. See, first, second part of the solution, yes, inflation premium rises by 2%. They have considered the inflation premium to be increased by 2%. What they have given, see friends, what they have given. What is the, yes, I will see from here. First part I will see. See, 13% was the, what is that, RM minus RF. RM minus RF, no change. RM minus RF, no change. RF becomes 9.18% in second situation. Earlier, RF, what, 9%, there. Okay, what they have done, inflation increased by 2%. What they have done, simply take your calculator, 9% is there. 9 into 1.02, they have taken 9.18%. Upon this 9%, okay, RF, if inflation increases by 2%, corresponding increase in the, what do you say, the RF. What they have done, 9% into 1.02, the 2% rise in inflation gives a corresponding rise at 2% in the risk-free rate. This they have considered. Are you understanding what I am trying to say? Which means, okay, if inflation rises by 2%, RF raises, but not by 2%. Okay, see, RF 9%, simply I can write by 2%. If this is the case, which means you are considering the inflation to be entire risk-free rate. The risk-free rate, I will tell you what it is. Risk-free rate is nothing but interest. Okay, interest rate. Right? Risk-free rate, now what is that? Risk-free rate, long-term government of India bonds, risk-free rate you will consider if in case of US, okay, US, the treasury bills, okay, US treasury bills, that will be considered as risk-free rate. If you see that interest, that is nothing but interest rate, that is nothing but short-term, long-term, 10-year long-term interest rate will be considered for risk-free rate. Now interest rate is there, this is nothing but interest rate. Now 2% inflation is increasing now. This interest rate will not increase by 2%. Are you understanding idea? Understand the concept? If inflation is increasing by 2%, okay, the interest rate will not be increased by corresponding 2%, which means interest rate has two components. One is the risk premium. The risk premium, okay, it is a compensation for two things. One is risk, then there is inflation premium. Are you understanding? Here, inflation increases by 2%. Now, it will increase the risk, but not by 2%. So, what they have done, into 102%, just into 102%, they have multiplied and taken. But this is also will not be exactly accurate. Okay, why this may not be accurate, I will tell you later, no issues, but they have considered computing this like this. Are you understanding? Okay, so 9.18 is derived by that. I am just explaining how they have solved in the institute module. Okay, I am not going deep into concept, it might be confusing at present. Now we are preparing for examination and I don't want to get deep into these concepts. Okay, see, very simple. How they have computed, I am sure. Next, plus 1.3 remains. See, in this question also, in this alternative, they have considered this, but other data relating to beta, okay, 1.2, they've also considered, which means all the changes I considered together. But 2% I consider, beta 1.3 from 1.2 it changed, that also I consider. Then expected growth rate 3% from 7%, that I will consider for valuation. Okay, I'll consider 7%. See here, not this is original. Okay, here, see, here they have considered beta, they have considered this for computing KE, but for valuation, they have considered the growth rate as 10% only. Are you all understanding? They have considered 10% only for KE minus GK, growth rate is 10%. Yes, correct. They have considered 3% also increases now. This is not, it is increased by 3%, sorry, it is increased by 3%, which means 7% is the growth rate, 7 plus 3%, 10% is the revised growth rate, which means here 10% they have considered. In the first alternative, what is that? Inflation adjustment, how they have done, plus considered all the three data together, cumulative. Then they have made the changes and found out the value. This is one way. Alternatively, they have given, even if you consider all the data together, what is the second alternative? Consider all the data together, but inflation is adjusted differently, in a different manner. Inflation, I'll simply add it to RF rate and RM. I will add RM and RF. Are you understanding what is happening? Which means 11% RF I adjust, okay, plus 1.3 into RM minus RF. Okay, return of the market also, since inflation is 2% increase, return will also increase. 15% they have assumed from 13% RM, okay, 15% it became, and RF 11% again. Okay, like this they have asked, they have computed KE. The computation methodology of KE changes, and they found out the new KE as 16.2%. Balance, everything remains same. They found out the value. Are you all understanding different alternative I am explaining? This is one way. This is first way where cumulatively everything was considered. In this alternative, okay, alternatively, if all the factors are taken separately, then solution will be this way. Okay, inflation premium 2% raises to 15.8%. KE is equal to 15.8% if inflation raises by 2%. Why? Because here they have computed, see, they have, what they have done in this way also, is the previous method. I told you, this is the original, what institute earlier used to give in their module. This is not the newly added thing. Okay, there what they have done, inflation 2%. Now RF simply you add, okay, without adding all this, RF if you add, you will get the total value as 13.8, okay, wherein they will not add RM. Are you understanding the confusion? Okay, every permutation and combination they have given, so that this question if it's asked, most probably everything, marks will be avoided even if you unknowingly commit the mistake. Why? Because see, in this method they have found out the new KE is 15.8. How they have found out? 11%, 9 plus 2%, inflation directly added. This was the earlier solution. Okay, I think the question is, it should be question ambiguous question. So you should alter the question instead of altering the solution. Okay, see, why I should ask the wrong question and expect, I give you all the alternatives and expect the alternative solutions. Instead, inflation premium ku badala, if risk-free rate is interest rate changes by 2%, they have given straight away. There is no issue at all. Okay, if they made changes to the question, then there will be no issue. Okay, just to change interest rate or RF increases by 2%, then you don't need to give these many alternatives. Only two alternatives you need to give. Okay, consider separately or cumulatively. That also, okay, only two alternatives must be given, and no need for all these many alternatives, I feel, anyhow. Hence the new equilibrium price, okay, you will consider old growth rate, everything remains same. The 7% earlier growth rate was there. First when you consider the inflation effect, you will not consider the growth effect. Growth will remain same, as well as the beta also same. If you see, where is the beta? Okay, the beta also changes. Beta also same. Okay, 15.8 RF plus 1.3 only you will consider 1.2 or 1.3 initially 1.2. This 1.2 only you will consider, not 1.3. you try it, you will get that. Okay, then growth rate increases by 3%, now growth rate 10%. All the remaining things, see again KE becomes 13.8, the original KE which we computed now, right? That KE will be considered, not 15.8 will be considered. Are you understanding? Beta rises to 1.3, hence revised cost of equity. Okay, all this given, and you will find out the value of the equity share. Okay, take question number 16. Sam Limited has just paid a dividend of 2 per share and it is expected to grow at 6% per annum. Okay, after paying dividend, the board declared to take up a project by retaining the next 3 annual dividends. Okay, this is D0, present dividend it pays, okay, just paid a dividend of 2. This is D0 and expected to grow at 6% per annum. Then, okay, there is a new project. By undertaking this project, okay, for the next 3 years, they will retain the dividends. Okay, it is expected that this project is of same risk as the existing projects. The result of this project will start coming from the 4th year onwards from now. See, okay, once you retain the money, the first 3 years you may not pay dividend, but from the 4th year, okay, the dividend will be increased since the earnings will also increase. The dividend will then be 2.5 per share. That is what they have given. From 2 rupees existing dividend, next 3 years no dividends, but from 4th year dividend is increased from 2 to 2.5, and it will grow at 7.5% per annum. Dividend growth will also increase. An investor has 1000 shares in San Limited wants a receipt of at least 2000 per annum from this investment. Show that the market value of the share is affected by the decision of the board. So what we have to do, very simple. Okay, without undertaking this project, what is the existing value per share? We will try to find out what is the existing value per share using the dividend growth model. Then considering the new project, okay, what will happen now? Then first 3 years no dividend will be there. From 4th year onwards, the dividend will grow forever at higher rate, 7%. That we will apply and find out the revised price. Revised price in the sense revised value of the share. We will compare this and we will try to find whether there is any value addition due to this additional project. So also show as to how the investor can maintain his target receipt from the investment for first 3 years. See, his target receipt is 2000 per annum. He wants to maintain how many shares he need to sell. Okay, is what they are asking, and improved income thereafter, given that the cost of capital of the firm is 8% per annum. Anything given or nothing given? Okay, this is the question that is being asked. Go through the solution. Okay, very simple. First step in find the existing value of the share. Without undertaking the project, what is the value of the share today? D1 by KE minus G. D1 nothing but D0, 1 plus G divided by KE minus G, you will get 106. However, if board implements its decision, no dividend would be payable for first 3 years and dividend from the 4th year will be 2.5 growing forever. Now, you tell me children what is being done now. The first situation, see what happens. You calculated D1 straight away, D1 by KE minus G, you applied this formula and calculated the value of the share today. But if the company doesn't pay a dividend for first 3 years, then D1, D2, D3 will be 0. Are you all understanding? Now, what you can apply now, from the 4th year you will receive dividend till the eternity, which means D4 to D infinity will be there. I can discount this, okay, I can apply this formula and find D4 divided by KE minus G. Okay, this will give me what? P3, price at the end of year 3, which means again if I discount using 3 years discounting rate, okay, present value factored for 3 years, okay, you will find the value per share today. See, very simple, 2.5 D4, this is nothing but D4 divided by KE minus G. Okay, this you will get what? This is nothing but P3. Now P3 you discounted 3rd year discounting rate, that is what they are doing. P3 divided by 1 plus KE whole cube. Okay, 1 plus KE cube. How much is that? 198.46. Are you all understanding? You will get P0, the value per share, or B0 you can say, fair value of the share today. This is 198.46. Up to tell me whether, see, before undertaking the project the value was 106. After undertaking the project the value becomes 198 now, which means it is prudent to undertake the project. So the price of the share is expected to increase from 106 to 198.45 after the announcement of the project. The investor can take up the situation as follows. Now, what I should do, see, we need to find out price at the expected price at the end of 3rd year, 2nd year and 1st year, so that I can decide how much share I need to sell to maintain my receipt of 2000 rupees. In the question, what they are asking, see, first they asked us to compare these two situations and whether the project will increase the share price or not. That we have solved. Now the issue is, okay, show that the market value of the share is affected by the decision of the board. We have showed it will affect positively, no issues. And also show as to how the investor can maintain his target. This investor wants a target receipt of how much? This investor wants a target receipt of 2000 per annum. This 2000, how he can maintain this receipt, they are asking. So which means at the end of year 1, you have to sell some shares. At the end of year 2, you have to sell some shares. At the end of year 3 also, you have to sell some shares. At what price he will sell? Probably at the current market price respective, okay, year end market price he will sell. Correct? Now, how many shares need to be sold? Now, first I need to find out the market price. Market price at the end of year 1, market price at the end of year 2 and market price at the end of year 3. Okay, how to find it? Very simple. They will ask P3, P2 and P1. Nothing else. This is P3, P2 and P1. How to find out? Very simple. You have P3 already found out na, D1 and D4 by KE minus G. That is what they are finding. Nothing but D4. 2.5 is D4 by KE minus G. 250 is the P3. Agreed? This 250, if you discount using third year rate, you will get 198.46. Okay, that we already computed. In the this is nothing but 250. Okay, come to price at the end of year 2. What you will do? Very simple. You have P3 in hand. This is P3. Okay, you did 3 years discounting rate to find out price today. Instead of 3 years discounting rate, what you do? Just 1 year discounting you do. Once you discount it, you will get from P3 to P2. Are you all understanding? 1 divided by 1.08. If you discount 1 plus KE, if you divide by 1 plus KE, you will arrive at P2. Again discounted, okay, back using 2 years rate, you will get P0. After 1 year, there is a mistake, I think in the institute module. 1 second. You have 231.48. 231.48 divided by 1.08. Okay, 214.33. This is mistake. No, please note the mistake. This is not 1.08 raised to the power 2. This is 1.08 only. Are you all understanding what I am trying to say? So there is no, you don't need to discount it 2 times. Yeah, when you discount 2 times, you will arrive at the 198.46. The price you will get. That P0 you will get. That is not required. You want P1 or P0? P1. So which means, okay, only once you should discount. 1 plus KE you should discount, and then you will get 214.33. This is the first year end price. You have 3 prices: P1, P2, P3. P0 or value today, that is fine, 198.46. That is irrelevant. For okay, maintaining the receipt, what do you need to calculate? Now, first year end I will sell some shares. Second year end I will sell some shares. For that I need to find out these prices. Next, what you will do? See, very simple. I have to maintain a receipt of 2000, at least 2000. They have told, na? See here, carefully see. At least 2000 per annum, which means it should not go below 2000. Okay, you cannot buy fraction of shares. Of one share, if at all, you should go above 2000, but the number should not go below 2000. So what you should do? Very simple. Okay, 214.33 is the first year price, share price, which means how many shares I need to sell. Okay, if I sell 9 shares, okay, it will be less than 2000. Hence, I will sell 10 shares. Next year, the price is 231.48. How many shares I need to sell? Okay, 2000 divided by 231.48. You will get 8.64 shares, which means 8 fraction you cannot buy. So 9 shares you will buy. 9 shares you will sell. 9 shares in the second year you will sell. The value will be 2083.32. Okay, last 250 is the price at the end of third year. How many shares I need to sell? I can sell exactly 8 shares to get the exact 2000 amount. Okay, these are all the amount receipt. At the end of third year, he would be having 973 shares. See what happens. First year sold 10 shares, second year sold 9 shares, third year sold 8 shares. 1000 shares he had. You reduce these number of shares. 973 shares will be the balance amount lying in his demat account. Okay, it's valued at 250. Will be valued at the end of year 3. It will be valued at what price? 250 rupees. So 250 into 973, that is the value of his investment. What is that value of investment? 2,43,250. Okay, on these 973 shares, he will receive the dividend income for the 4th year, which is 2.5 per share How many shares? 973. 973 into 2.5, 2432.5. This will keep on, okay, increasing in the sense this will continue forever. This will continue forever. So if the project is taken by the company, the investor would be able to maintain his return at least 2000 for the first 3 years and will be getting increased income thereafter. If you see the current income, okay, 1000 dividend, if you see currently, what is the dividend? 2 rupees, a P0 and a 2. 2 into 1000, 2000 was the dividend, existing dividend. If the project is not undertaken, existing shares, 1000 into 2 rupees dividend, 2000 would be the dividend amount. But what happens initially for 3 years, okay, he is withholding, but after 4th year, the dividend amount is also getting increased to 2432. Good quality question. Okay, mark it as important. Mark it as important. Next. XYZ Limited paid a dividend of 2 for the current year. The dividend is expected to grow at 40% for the next 5 years, 15% thereafter. The return on 182 days T-bill says 11%. What is this 11%? Risk-free rate. This is nothing but T-bill risk-free rate of return. And the market return is expected to be around 18% and variance of 24%. The covariance of XYZ Limited return with that of the market is 30%. Covariance of, okay, security XYZ and market. Okay, this is covariance of, I can call it as, this is covariance of XYZ and market M. Okay, this is nothing but 30%. Right. You are required to calculate the required rate of return and intrinsic value of the example. The simple straightforward question, frequently also asked. Okay, recently they have asked in May 24 attempt, I think. Okay, very simple. The issue under consideration is calculation of beta. Beta, there is a formula. There are so many formulas which we will learn in portfolio management, not an issue, but one of the formula is nothing but covariance of security S and M. S means security. Here security is XYZ Limited. Covariance of S and M divided by sigma M square. Now the sigma M square is nothing but market variance. Here the market variance, market return 18% and variance is given straight away as 24%. Upper simply 30 divided by 24 will be the beta. Are you understanding? 30% is the covariance and 24% is the variance. Okay, you will get the beta. You replace it and you will find the KE. Then D1 by KE minus G. Okay, you will apply here. You have holding period of 5 years. Upper D6 by KE minus G you will get P5. And then D1, D2, D3, D4, D5, P5. Discount all this. You will bring it to present value terms. You will get the value of the share. I think. See the solution. First beta computation, covariance divided by variance sigma M square, variance of the market, which is 1.25. You will get the beta as 1.25. Then apply this to your CAPM, capital asset pricing model. You will get the KE as 19.75. Straightforward. Thereafter, what you do, D1, D2, D3, D4, D5. Okay, and terminal value, which I can also write in the table. Okay, sometimes institute has presented like this, or you can also present it in the tabular form itself. Year 5 you can write at the end of year 5. This is nothing but P5. Okay, and what is the P5? Present value of term. They have discounted and found out the present value. This amount alone you can compute and write it P5. Then same discounting factor. You will arrive at 105.77, 105.77, or this is the present value. Now you add plus 16 plus this number here, 16.36 plus 105.77. Okay, that they have added. See, 122.13. You will get the value per share. Very simple and straightforward. Beta computation only is important. Next, question number 18. Rahul Limited has surplus cash of 100 lakhs and wants to distribute 27% of it to the shareholders. Okay, dividend. This is a buyback question, very good quality question. I think 1 or 2 questions are only there in this buyback segment. One is regarding the reverse computation question, which is I think given in business valuation or mergers and acquisition ICAI module. They have given that question there, maybe. Okay, there are 2 questions. This is a one of the question which they have put in security valuation segment. Okay, see, this market as important. This buyback question market as important. See, Rahul Limited has surplus cash of 100 lakhs and wants to distribute 27% of it to the shareholders. The company decides to buy back the shares. Finance manager of the company estimates that its share price after repurchase is likely to be 10% above the buyback price if buyback route is taken. See, the company if takes buyback route, if the company buys back its shares, what happens to the market price now? The share price after the buyback will be 10% above the buyback price, which means the question doesn't mention what is the buyback price. The price at which the share is being bought is mentioned or not mentioned, right? It is not mentioned. But what they are saying is it will be 10% above the buyback. If buyback price is X na, okay, the share price, market price per share after the buyback will be 110x, 110% of X, which means 110% of the X buyback price. That is the understand. The number of shares outstanding at present is 10 lakhs, current EPS is 3. This is the data that has been given. Okay, which means 10 lakh shares outstanding, current EPS is 3 lakhs. Surplus share, cash available is 100 lakhs. Okay, 27% means 27 lakhs is being distributed as buyback, which means, see, the company can either distribute a dividend or can buy back. Okay, it is not, buyback is also nothing but, okay, distributing the surplus cash to the shareholders. Here they are intending to distribute 27% of 100 lakhs, not 27 lakhs is the buyback amount to be distributed, amount to be bought back. Okay, the value of the shares to be bought back is 27 lakhs, correct? The price at which the shares can be repurchased if the market capitalization of the company should be 210 lakhs after buyback. Right? See, they have asked 3 questions here. One is that price at which the share price can be rebate. This is buyback price. Buyback price. Okay, the price at which the shares should be bought back. That is the question. Next, they are asking number of shares that can be repurchased. How many shares is to be repurchased? Okay. Then the impact of the share repurchase on the EPS, assuming that net income is the same. Okay. So to find question number 2 and 3, okay, solution to segment 2 and 3, you need to find out the first buyback price. You need to find out, very simple. What they have given, from there we will work out. Okay, the price at which the market capitalization of the company should be 210 lakhs after buyback. Very simple. Market capitalization, I can write it like this. Market capitalization, what is MCAP formula? Okay, as such, number of shares into MPS, correct? Here only I need to have your attention. Number of shares na, see, the MCAP before buyback, after buyback, they are saying after buyback. The market cap after buyback should be 210 lakhs. But this you should equate it to 210 lakhs. I think 210 na, what they have given? Yes, 210 lakhs. But now number of shares should be taken after repurchase. This is nothing but number of shares after repurchase, and this MPS also market price of the company, okay, per share after repurchase. Are you all understanding? This is nothing but they have given na 110% of X. If buyback price is X, this will become 110% of X market price per share after the buyback. They have told na. Are you all understanding? Market price will increase by 10% of the buyback price. That is what I am writing. Number of shares after buyback. You tell me what will be the number of shares after buyback. Very simple, yeah. Existing number of shares minus, okay, shares bought back. Okay. Now, how many shares are to be bought back? That is, see, is given in the question or not given? That is not given. Now, what you will consider? See, very simple. Yeah. How many shares to be bought back? You will find out. Correct? But how to find out what is number of shares? How to compute number of shares? Well, the value of shares to be bought back 27 lakhs divided by buyback price. This will give you 27 lakhs is to be the amount to be bought back is 27 lakhs divided by, okay, the buyback price will give you the number of shares to be bought back. Agreed? Appo number of existing shares, current share minus, okay, shares to be bought back will give you number of shares after the buyback into market price of the shares after buyback, which is nothing but 10% of the 110% of the buyback price into X. So equate it to 210, you will arrive at the value. This is what they have found out. Okay, forming the equation is important, and solution you will automatically get. See here, original shares minus shares bought back, which will give you what? Which will give you original shares minus shares bought back will give you number of shares outstanding after buyback into 1.1p. Buyback price be P. Let P be the buyback price here, and I explained using X. They have taken as P. Same here. Okay, 1.1 na 110% of X, which is nothing but 1.1. Okay, 1.1p into this number of shares after buyback, which is nothing but existing number of shares 10 lakhs. How they have found out? Very simple. Question that they have given. See what they are saying. 10 lakh shares and given. Upper 10 lakh shares existing number of shares. This is original shares minus 27% of 100 lakhs, which is the amount to be distributed as buyback. I explained minus 27 lakhs divided by P, which you don't know. Correct? You solve the equation. Okay, this you should equate it to 210 lakhs. That, okay, this you should equate it to 210 lakhs. Market capitalization of the company is 210 lakhs na. That you need to equate it to 210 lakhs. So 11 lakhs into P minus 27 lakhs into 1.1 is equal to 11 lakhs P minus 27.7 lakhs. Again 11 lakhs P minus 27.7 lakhs, or 11 lakhs P is equal to 27 lakhs, 210 lakhs plus 29.7 lakhs. Here it should be 210 lakhs is equal to, equated to 210 lakhs. Okay, you will arrive at the price per share, 21.79 per share. Okay, this is you found out now. What is the P? So 21.79, what is this? This is nothing but buyback price, the price at which the share should be bought back. Now, number of shares to be bought back, very simple. Total amount 27 lakhs to be bought back divided by 21.79 buyback price. You will get approximately, this is the number. Okay, then new number of equity shares. Okay, new equity shares in the sense, number of shares outstanding after buyback is what they are asking now. Yes, see, EPS of the company after the buyback they are asking. The impact of share repurchase on EPS assuming the net income is same, which means net income of the company is how much? Net income of the company given, yes, EPS is given as 3 rupees per share. Okay, what is the existing number of shares outstanding? 10 lakhs. For 10 lakhs into 3 rupees, 30 lakhs is the net income. 30 lakhs is the net income. Now you need to find out, okay, what is the impact of the buyback. See, very simple. This is existing number of shares 10 lakh minus buyback shares. How many shares you bought back? Total comes to 8.76 number of shares outstanding after buyback. Okay, this you have in hand. You should use EPS. You need to find out now. Okay, impact in EPS. Now first you need to find out revised EPS. EPS post buyback. Post buyback EPS. How to find out? Very simple. Post buyback after tax. Profit after tax after buyback. But in this question, it will remain same they have given after buyback. It need not be same, but they have given assumed to be same. Divided by number of shares after buyback. After buyback. Okay, how many shares are there outstanding? 8.76 lakhs. 30 lakhs divided by 8.76 lakhs, 3.43. Thus, existing EPS is 3 rupees. The revised EPS, buyback shares, okay, buyback will enhance the EPS. Always remember, buyback will enhance the EPS because generally, okay, because of the buyback, the number of shares are getting reduced. Our denominator, if number of shares are getting reduced means, okay, same wealth is getting shared by less number of shares. Hence, the earnings per share will increase. Okay, question number 19. See, till now we discussed the equity valuation segment.